Today the topic is about receivables. Essentially when you sell for credit and the customer is supposed to pay you later. Most of the transactions in the modern world are based on credit. We never pay cash to the delivery guy when the goods arrive. So it has its own chapter in accounting education. So first you need to remember that when we sell, we record revenues whether we get paid in cash or not. Revenue and income do not depend on cash. So long as we know we are going to get paid later, we can register the revenues. Now, however, there is a trick. If we are having credit sales, accounting rules forces us to make provisions about the future. What if we do not get paid? So companies need to make estimates of future non-payments. For example, Verizon recorded about 100 billion revenues during fiscal 2022. Their receivables for the year are about 25 billion. And they also estimate that 1 billion of these will never be paid to them. Hence, they put 1 billion loss under the income statement as a bad debt expense. These losses are estimated today, but they will happen in the future when the customer defaults. It is a forward-looking estimation. Accounting is conservative. Ha ha ha. Losses have not happened yet. They will happen in the future. So we put an expense on the income statement from today. In this particular example, the company predicts a bad debt expense of $5 from sales of 100. Since accounting is conservative, our income is lower today and it is only 95 rather than 100. At the same time, assets are less by 5. This account under assets is called allowance for doubtful accounts, and it is a contra asset account. As you see, we sold for 100, but income and retained earnings are only 95, and assets are only 95. We have provisioned for future losses of 5. Remember we had provisioned $5 of non-payment? Now assume that one of your clients that owes you $3 goes bankrupt. They will never pay you. You know that $3 of receivables have to be written off. We also need to take 3 from our allowance. Now the net receivables is still a 95. However, the total value of receivables is lower, and the total value of the allowance is also lower. Think of it this way. We expected $5 not to be paid to us because one client went bankrupt. We take it out of our financial statements. We are left with 97 of total gross receivables and an expectation of 2 more that we will not get paid. Our net is still 95. Why don't our assets go down if customers do not pay? Why don't we have a loss on the income statement? Well, because you already put the loss in the period before. We were conservative and we lowered income already. Now when true losses, the write-offs, happen, we do not lower net income again. It was already reduced earlier.